Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Hormuz Patakia and Reema Tendulkar. Hey guys, good morning. Well, after a while, we're seeing some green across all the indices, right? So Nifty above that 25,100 mark currently. It's a 75-point uptick that we are sitting with. The mid-caps outperforming 0.4% there. And Bank Nifty is the one which is lending support to Nifty today. So that one is up 0.5%. And it's all about earnings. It's all about Tesla. It's all about the India-US trade deal. So a lot happening. Continues to be a busy day again.
And Asia again is on the positive side.
Yeah.
So on the whole, you've got green on the Asian market screen. And not to forget, I think the biggest skew is India's CPI print at 2.1%. That has raised, hopes that at some point another rate cut could be forthcoming, even though the RBI, governor was very clear that he's front-loaded the rate cuts. But I guess the hope still stays alive. So that's the big macro trigger. And it's good to see that, despite HCL Tech missing the mark on margins this time, the rest of the IT stocks are moving higher. So Infosys, Wipro reports numbers on Thursday, Infosys next week on the 23rd. But the rest of the IT pack, X of HCL Tech, is actually higher, which means that maybe in the near term, the bad news could be in the price and for HCL Tech being priced in.
Or maybe just looking at the fact that they've raised the lower end of their revenue guidance, which means that maybe the momentum is still on the positive side and that's giving some hope that maybe Infosys or maybe even Wipro could do something similar in their results. But yes, the recovery in the IT names is what is propelling the index higher as well. And you can see in their intraday charts as well, all of them have started moving higher post 10 a.m. after making that intraday low. And then the IT index now at the highest point of the day, 0.8% higher. And some of the other movers then within the broader markets, there are plenty of them. Look at Sterlite Tech, 8.5% higher on that stock, among the top gainers on the BSE small cap today. And Nesco is the other one, almost 7.75% higher on that name as well. Some of the MFI names like Spandana Spurti doing very well, almost 7% higher today. And of course, some of the earnings reactions. Rallis at one point was up 6%, still holding on to those gains. And of course, Tejas Networks has recovered from the lows of the day, was at one point down almost 8% at the start of the trading session. We just heard from the management a few minutes earlier, 5% lower now on that stock, continuing to recover from the lows. And the stock of yesterday's trading session, Ola Electric, up 20% yesterday, seeing some bit of profit booking from higher levels now, down 3.5% in today's trade as well. But as Reema was highlighting, IT has been the focal point early in the morning, and HCL Tech is the stock in focus, was down 4%, is recovering from the lows, and that recovery has pushed the IT index too at the highs. Is there some optimism here, Reema?
Well, first, let's start with the big picture that it's still down close to about 3%. And there are a couple of reasons for that. One, in Q1, the margins of the company disappointed. Margins came in at 16.3%, down 160 basis points. The company has lowered the margin forecast for the full year by 100 basis points. The new margin guidance stands at 17 to 18%. So that's reason number one. Reason number two is some brokerages have downgraded the stock. So JP Morgan downgrades it to a neutral. They're saying AI deflation is playing out via margin erosion. Nuvama also a downgrade. And Ambit is saying that first, the growth of IT companies got hit, and now the next casualty is going to be margins. Remember, even TCS has refrained so far on giving a wage hike. The third reason is that the HCL Tech share price has outperformed its peers. On a year-to-date basis, for instance, the TCS is down 20%, HCL Tech is flat. In the last 5 years, HCL Tech has gained 150%. But as you said, there is a bit of an intraday recovery, and the reason for that could be because while in FY26, margins are hit for a variety of factors. There's a macro uncertainty, the investments, there's a client bankruptcy, the company is undergoing a restructuring. But the company is saying by FY27, 1 year later, margins will get back to the earlier level. So therefore, Nomura says that maybe it makes sense to ignore the margin pressures in the near term because eventually it's going to come back in FY27 and focus instead on the revenue outperformance. And HCL Tech, amongst the large cap peers, is likely to outperform on the top line. And that is also the reason why Jefferies has upgraded HCL Tech despite a miss in Q1. And Jefferies' target price, as you can see, is at 1850.
Okay, all right. So that is about HCL Tech. In fact, in its earnings call, post the numbers, C. Vijay Kumar, CEO and Managing Director of HCL Tech, says margin impacted is due to lower utilization and delayed ramp-up of a project. Listen into his comments.
We observed that the environment remained stable from an overall perspective, with some variations across specific verticals. It also did not deteriorate as feared at the start of the quarter. Our operating margin came in at 16.3%, which was lower than our plan. While Q1 has been historically the weakest quarter for us, the below plan operating margin was driven by the fact that our utilization dropped due to a delay in ramp up for a specific program. We also had a one-time impact from a client bankruptcy. We had a couple of large deals in the pipeline which were expected to close in Q1. These deals have moved to Q2. This delay is unrelated to external factors or macro factors. We are optimistic about their conversion, and if all goes as per plan, the TCV number should see a step up in the coming quarter.
Okay, all right, that's about HCL Tech, but the other stock which is doing really well is Rallis India. Doing well on trade, and this is after a lot of quarters that we've seen some recovery that has come by. Revenues are up 22% on a YY basis. The EBITDA also went higher by 57%. Margins, they were higher this time, came in at around 15.7%, which compares with 12.2% in the quarter gone by. Profits almost doubled, came in at 95 crore rupees, which compares with around 48 crore rupees in the quarter gone by. The company said that they have seen double-digit growth across their business segments, and EBITDA growth was driven by volume growth as well this time. In terms of their segments, the crop care business, there the revenue was up 16% at 652 crore rupees. Seeds, which is the higher margin business, that saw a growth of 38% at 305 crore rupees, and the management did indicate that Q1 saw strong margins because of the growth in the seeds business. They also gave commentary on the outlook going forward. We spoke to Gyanendra Shukla, MD and CEO at the company. Listen in to what he had to say.
Overall margin, obviously, so gross margins more or less remain flat. I think Q1 also has a higher percent contribution coming from seeds. Seeds generally is a higher margin business. Our soil and plant health business is higher margin business. So that is reflected in the overall number. I think as we move forward, I think Q2 is going to be more domestically important. It has less weightage on the seed. So I haven't worked out those numbers for the Q2, but I mean, it's a mix of business that will dictate how things move forward.
No, other than these IT names that have recovered from the lows of the day, one of the stocks that is doing well though is Hero MotoCorp, and that is after the company put out its annual report where there were some comments with regards to some of the plans for the future. At the highest point of the day is Hero MotoCorp, 3.5% higher, and Sudarshan is here to tell us what exactly did that entail, Sudarshan.
So it's top Nifty gainer because the company has released annual report, and in that it has given the basically strategies for FY26. So few points, basically few headlines if I can mention. First one is global expansion. Second, unlocking new value in the core segment. Third, focus on premiumization. And fourth, expanding footprint in electric mobility. Also, company has termed FY26 as the year of acceleration. So now first talking about the global expansion. In FY25, company has achieved 43% growth in international markets. That includes South Asia and Latin America. Now in FY26, company is saying that it will be expanding its presence in Germany, France, Spain and UK in Q2 of FY26. On the premiumization front, it's saying that Harley Davidson X440 joint offering continue to be strong, and now on the base of that, it's expanding the collaboration with new platform that company is looking to launch very soon. On the retail market front, it's saying that it's on upward trajectory in the calendar year, and now company is looking to maintain that growth during the year, that is FY26. And on the retail finance penetration part, it's saying that it remains steady at the level of 65%, and even inventory levels remain well calibrated. Now on the market share front, it's saying that in 125cc segment, in which company is the leader, and in FY25, it had seen a rapid market share gain, and it believes that going forward, even in FY26, that market share gain trajectory will continue. So on the back of these commentaries that company has given, you are seeing a big move in the stock, and currently it's up more than 3%.
Oh, absolutely. top gainer on the Nifty. Sudarshan, thanks a lot for that. And speaking of top gainers, the index is now nearing the 25,225 mark, almost 150 points higher now for the Nifty, almost a 500-point uptick on the Sensex as well. Take a short break. All things commodities on the other side with Manisha Gupta. Stay tuned. Welcome back. Fertilizer stocks are doing fairly well for themselves in the first couple of hours of the trading session. Fact is the top gainer on the Nifty 500 right now, fertilizers and chemicals, Travancore, 8.5% higher on that stock. Of course, mind you, this stock has very little float in the market, so keep that at the back of your minds. RCF is the other one, 4% higher on that stock as well. And Deepak Fertilizers is the other one with a 3% gain. So fertilizer stocks doing fairly well for themselves. But a shifting focus now to commodities. Manisha is here with us, and it is today the focus on the Health Ministry's advisory on the sugar and edible industry, Manisha.
Oh, well, Hormuz, we saw those statements come in from the ministry yesterday itself, and I've been talking to a lot of industry participants, FMCG companies since then. And well, they don't really like the language here. What the industry tells me is that the push should be more towards perhaps work-life balance, because internationally the consumption of these commodities is much higher, but then they have the time to go to gym, etc. And for the Indian markets, it also should be about eating in moderation. Well, yes, educating, but not scaring them away, and promoting health and fitness should be on cards rather than telling them to not eat certain essential commodities. So this is the kind of feedback that I have from various companies. But just going back to you said, well, yes, the Health Ministry has put advisory to government institutions, hospitals, ministries, departments, even schools for that matter, to ply boards with warnings and educating them about health risks perhaps from eating or overeating many of these commodities like sugar and edible oil. It also is to make people aware about health issues, and that extra consumption can lead to some damages here. The Health Ministry estimates also put out, remember yesterday, those numbers as well, that in 2021, 18 crore Indians were obese or overweight and unwell, and that number can go to 44.9 crores by 2050 if nothing much is done. I want to take now, you through on the kind of numbers that we see in sense of per capita consumption. So when it comes to sugar, India's per capita consumption per annum per person is 19 kgs, which is much lesser than the global average of 27 kgs. So we're not exactly there, but it is concentrated one, and there is no fitness regime that Indians have, is the reason we are called the diabetes capital of the world perhaps. The next screen should come in on your screens, and that tells you about our edible oil consumption as well. So for India, it's 18 kgs. Global average for edible oil consumption is 24 kgs. And the highest that you have in sense of global consumption is also 35 to 40 kgs. So we are much below in sense of global averages in sense of consumption for many of these commodities. But again, as I said, we have very relaxed or no work-life balances, and is the reason the threats here are more.
The minute everyone started smiling the minute you said, I think the focus needs to be on work-life balance. But similar to the way we have those tobacco warnings on cigarette packs.
But people really don't follow it. So I don't know how much will they follow this advice as well. But at least we'll not have ads which will say meetha hai khana aaj pehli tarikh hai or stuff like that, because now they're like no meetha or meetha in moderation.
Imagine having a statutory warning on a chocolate packet. Like, consumption of sugar is injurious to health.
I mean, what do you have to say that about that, Manisha? Are you a person who likes sweets?
Well, I'm really watching it. I've been talking to the cross-sector companies as well and industry. There are importers and processors and exporters and value addition products as well. And they're all trying to come out with their quotes on this, their reactions to this, on what they think about it. Also, when you look at the last few years, the sugar and the edible oil consumption in the Indian markets has kind of plateaued. So earlier, if it was 500,000 tons per annum, it is at 0.2 million tons. So we already are looking at that slow there, but the market doesn't expect it to degrow. There could be a slower growth.
Okay, there'll be a slower growth. Maybe people will contribute to that slower growth. We'll have to see which way things go. Thank you, Manisha, for joining in as always. And an interesting update, right? Talking about work-life balance and balanced diet as well. Very important, absolute need for the hour as well. But on that note, we'll slip into a short break. When we return, we'll discuss market technicals with Mitesh Thakkar and also discuss his top trading bets.
Welcome back. Just before we go to Mitesh Thakkar for a quick chart check, some flashes on your screen. Swaraj Engines, the first of the earnings of the day, and that stock has now come sharply off the day's high after its earnings performance. So you just saw the EBITDA number a few seconds earlier, 16% higher on the EBITDA front, and 16% higher on the sales front, and sales were up 16%, but then the stock has come off sharply from the highs of the day. Now at one point was up 4.5%, now just up 2%. So you get more details on your screens now. Net profit up 16% at 50 crore rupees. You get more details on the EBITDA front, on the sales front as well. Sales were up 16%. The EBITDA up 12.5% on a year-on-year basis. So that too at 67 crores. But the stock is off the highs of the day. Mitesh Thakkar joins in for a quick chart check. Mitesh, thank you for joining in again. We've seen that move past that 25,150 mark, at least for now, back above that 25,200 mark. Do you use that to exit your longs, if any, or do you see this moving further higher towards the 25,350 zones, and your stock recommendations as well?
So look, I think around 25,300 is where I believe the market will face a lot of supply. One, there was a falling gap between 25,340 to about 25,320, which was on Friday. And a couple of moving averages are around this 25,300 zone. So I think this is the level, maybe another 40, 50 points higher, where you would want to start taking some short positions with a stop about 25,350. And in case we don't get past those levels, then good chance that we'll retest 25,000, possibly 24,850 as well. So in that sense, a mild negative view on the index. And on the stock, I have one buy and one sell call. ITC is something which has come on the radar on the buying side. It's breaking out of a good consolidation. So keep a stop at about 417. And look for targets of around 430 on the upside. And on the negative side, I have a sell call on Bajaj Dock if it breaks levels of 3,100. So it's about at 31.25, 30 zones. Sell below 3,100, you can stop at 30-35, targets for around 3,020.
Okay, take that point, Mitesh. That is about a technical check on the market levels and individual technical picks as well. Let's talk about the oil and gas space. There is a public notice which is issued by PNGRB, which is the regulator for the oil and gas space. They have flagged irregularities when it comes to the PNG pricing, the domestic PNG, which basically we use in our homes, in our kitchens as well. They say that all these companies must have a uniform rate irrespective of domestic household consumption that these consumers are doing. So basically, once the consumption increases, the rate changes. And that is something that they are not liking right now, the regulator that is. Now remember, 10% of MGL's volumes are coming in, the PNG volumes are coming in. And for Gujarat Gas, around 8% volumes are from the PNG segment itself. In their note, PNGRB says that they need to, certain CGDs are implementing a telescopic pricing structure for PNG consumers. That means that once a threshold for consumption is crossed, they increase the pricing or change the pricing. But PNGRB is of the view, since it is going to consumers, final consumers, there should not be a volatile pricing which is dependent on consumption. They say such practice leads to unauthorized use of subsidized APM gas by commercial consumers, because largely APM gas is for PNG and CNG CNG, which basically caters to an individual or final consumer, not for commercial usage. So they are saying that they need to review this pricing and there need to be changes to pricing so that the final consumer tends to benefit. There's no volatility in pricing and it is not for commercial use. So it has just come in as a warning, or I would say it's just a public notice where they are looking at this irregularity. There's no impact as such because it's just a public notice yet. There is no final decision, but important to track because if it does come through, there could be some impact on margins going forward.
Thank you for explaining that. Get into a break. On the other side, we'll discuss market fundamentals. Devang Mehta from Spark Capital Private Wealth joins in next. Welcome back. In the thick of the earnings season, it's kick-started with IT, but soon all the other sectors and companies will follow. So it's a good time and it's a good way to prep you up for the metal sector. This is Quarter Se Quarter Tak. We'll get you the earnings expectations from Nigel, who will tell us how Q1 is likely to pan out for the metal and mining sector. Nigel.
Let's begin with the ferrous space first up, where steel companies are expected to deliver a strong performance in the first quarter. The steel EBITDA is projected to rise between 4 to around 15% on a quarter-to-quarter basis. That's thanks to two factors. One is a rise in domestic steel prices by roughly around 2,000 to 2,500 rupees per ton, and a decline in coking coal costs by around $10 to around $12 per ton. However, this margin improvement is expected to be partially offset by higher iron ore cost as well as lower sales volumes. The volumes could decline by around 3 to around 17% quarter-on-quarter, mainly due to the planned maintenance shutdowns and muted export demand. And also the early arrival of monsoons, well, that's going to be a bit of a dampener on the volumes front. On a company-specific basis, all companies will report an improvement on the EBITDA per ton. Tata Steel India, well, the EBITDA per ton is expected at around 14,500 rupees per ton, while Europe is expected to trim its losses to around a negative $28 per ton. That's down from close to around $40 per ton in the previous quarter. JSPL as well will report a solid gain. The EBITDA per ton is expected to jump up to around the 13,850 rupees odd, while JSW Steel will clock an EBITDA per ton of around 10,820 rupees per ton. SAIL, well, that'll see a modest improvement. The EBITDA per ton will move closer to around that 8,000 rupees odd mark. Jindal Stainless from the stainless pack, well, that'll report a good bounce back. Remember, quarter 4 was quite soft. This time around, there'll be a 10% quarter-on-quarter growth in the consolidated EBITDA per ton and could come in the vicinity of around 18,200. Two factors support them. One is realizations, which are higher, and the cost of production, which will be relatively lower. Moving to the non-ferrous side of things then, quarter 1 is expected to be soft. That's because of the decline that we've seen in commodity prices. The average LME prices for aluminium as well as zinc, they are down by close to around 7% on a sequential basis. That's what could weigh on the profitability as well as on the top line. However, silver has bucked the trend. It's up close to around 5 to 6% odd. It's hit its highest levels we've seen in more than 10 years. Coal India, though, they're expected to drop a 20% drop in the EBITDA. That's because of lower volumes and pricing. You have also seen the e-auction prices that are lower. The cost of production for them has moved up as well, so that's what will hurt Coal India. NMDC could see a 5% growth in the EBITDA. That's because of the higher volumes, which will jump up by mid-teens, though the benefits will be limited due to higher cost of production and lower realization per ton. Hindalco's India business, well, that'll get hit because of aluminium prices, which are down. And also we have seen that, the cost of production as well could get a hit a little bit. While Novelis, its overseas subsidiary, that will see a 9% quarter-on-quarter drop on the EBITDA per ton, should come in at roughly around $450 on a per ton basis because their operations have been impacted by tariffs on Canadian imports into the United States, rising input cost as well. Vedanta, well, on a consolidated EBITDA basis, there'll be a decline out there because of aluminium and zinc prices. Both of them are down by close to around 7%. However, gains from lower alumina cost and increased captive sourcing, that's what will help partially offset some part of that impact. To sum it up, metals sector in Q1 FY26 is expected to be a tale of two halves. Steel companies are poised to report strong earnings momentum supported by rising prices, falling coal cost, while non-ferrous players, they'll face profitability pressure owing to the drop in commodity prices.
Okay, take that point. Thank you so much, Nigel, for lining up those expectations from the sector. It's all about earnings and what we're expecting from the numbers. Yash is joining in now. It's all about the insurance space now. HDFC Life reports its numbers. Yash, what is the expectation?
Well, that's correct. So HDFC Life, of course, a Nifty company reporting its numbers today. The numbers are expected post-market hours, so about 4 o'clock is when we are expecting the numbers. In terms of expectations, the APE growth is expected to remain muted, though the ULIP share will be higher in that, and that could impact the margins or keep them range bound. In terms of specific numbers, the total new business premium, the expectation is that we could see a 15% growth. The number that we're looking at is about 7,489 crore rupees. Total annualized premium equivalent, that could see a growth of about 11%. The number that we are eyeing here is about 3,186 crore rupees. Retail APE could see a similar growth of about 10% at 2717 crore rupees. Value of new business, the improvement here could be higher. About 14% growth is what we're expecting at 817 crore rupees. And most important, as I said, the ULIP share could pick up, which could keep the margins range bound. So the margin improvement that we're looking at is just about 53 basis points. The margins could come in at about 25.63% versus 25.1%. Important to point out that the stock has seen a very strong rally in the last 3 months. In the last 3 months, the stock is up 8%. In the last 6 months, the stock is up 23%, trading at about 2.2 times forward price to embedded value. So the numbers in context with how the stock has behaved becomes very important today.
Yes, thanks a lot for that. Of course, we watch out for HDFC Life, one of the two insurance majors reporting results today, ICICI Prudential being the other one. What's the street expecting there?
Well, of course, ICICI Prudential is going to be the next life insurance company reporting its results today. As far as numbers are concerned, the total new business premium expected to see a muted growth of just about 6% at about 4,000 crore rupees approximately. Total annualized premium equivalent, that is expected to see a stronger growth and largely coming from the group business. So the growth that we're expecting on total APE is 23%. The number that we're looking at is about 2419 crore rupees. Retail APE, as I said, the group business is going to expected to perform. Retail business is going to be difficult in this quarter. So we are expecting a contraction of about 19%. The number that we're looking at is 1,356 crore rupees. Value of new business growing by 34% at 620 crore rupees. Margins, though, are expected to remain on the softer side, down 43 basis points at 23.57% as compared to 24%. Out of the entire life insurance pack, ICICI Prudential Life and LIC are only the two stocks which haven't rallied very strongly. So ICICI Prudential Life, that has gained up just about 1% in the last 6 months, 16% though, as far as the last 3 months is concerned, trading at a valuation of 1.6 times forward price to embedded value.
Thank you very much for that. Let's quickly talk about Tejas Networks. That is one of the casualties of the day. And that's because the numbers have been very, very disappointing. The company's top line has fallen between 85 to 90%, both on a quarter-on-quarter and on a year-on-year basis. So the top line has come in only at 200 crore rupees. It's a sharp decline compared to the prior quarters. Now, the reason for that is they were expecting the BSNL order to come through. But that purchase order came through only after the quarter closed. And that also, as of now, it's the purchase order. I think the final deal is yet to be signed. So that was reason number one. But even outside of that, the company did say that there were certain delays in the shipments. So delayed inventory arrival, shipment clearances for a few customers, all that impacted the top line. Now, courtesy the big drop in the revenue, the company also reported a big EBITDA loss of 126 crore. And that resulted in a big profit decline of nearly 194 crore rupees. We tried to chat, we spoke to the management, and this is not a management we often, speak to, but they did indicate that, one, on BSNL, the street fears that, what if this BSNL comes to an end, right? You can't be a one-trick pony. To which they said that, BSNL, if it has to be a pan-India player, it needs a lot of 4G, 5G upgradation of the network. So basically indicating that the opportunity is there for BSNL. Secondly, they also said that, but we don't want to be only dependent on BSNL. We want to increase our international share. In fact, the focus of the company is to get in global operators also. So they're saying their aspiration is that the contribution of international revenues will go up from the current 18-19% to about 30 to 40%. But I think this year is still going to be a little bit of a challenging and a transformation kind of a year. In fact, let's listen in to what the management had to tell us.
In FY25, we came off on the back of a really large project, this BSNL 100,000 sites, which we had to deliver in a very accelerated way, and that kind of resulted in a huge bump up of our revenues from FY24 to 25. So obviously, we are all been very clear that FY26 is not going to be in the background of FY25, and we should look at our business in the context of FY24 and so on.
What you see as reported receivables are to a large extent or significantly on account of the BSNL 4G project that got executed over the past few quarters. In fact, the last quarter was the completion of the project. Now, those receivables are expected to be collected over a period of time based on certain milestones related to implementation of the project. So we should see that coming down over the next few quarters within this financial year. Also, a part of these receivables are essentially against that. We also have received an advance on this project of about 1460 crores. Now that lies in the other liabilities because some of the milestones that were to be delivered are yet to be completed. So on a net basis, I think the actual receivable number is much lower than what you see on the reported statements.
Okay, that's Tejas Networks for you. Get into a break. As promised, on the other side, we'll talk about the markets, where we're headed, individual stocks with Devang Mehta of Spark Private Wealth.
Welcome back, and as promised, Devang Mehta from Spark Capital Private Wealth is now joining in to discuss the markets and some of his top ideas. Devang, good morning. Thank you for joining in. The conversation all around has been with the IT results that we have reported so far, and they flattered to deceive, to say the least. Now, would you believe that, okay, the first half might just be the bottom that the sector has been looking for a while now, and then we start seeing growth from the second half courtesy of the low base?
Good morning. Thanks for having me on the show. I think clearly the last 1.5 to 2 years, we have been a bit underweight on IT, to say the least. In fact, actually has not favored the large cap IT sector all through. Now, the reasons for that are clearly there are more headwinds than tailwinds, as we all know. Somebody who probably grows at a single digit, and just because the valuation has collapsed from what it used to trade in terms of its P multiples, I don't think it makes a sort of a bargain hunt. There are so many sectors, there are so many themes, there are so many micro themes in India which are doing well. So I guess that buying it at a value zone somewhere, but with no growth, it would just probably be a bounce back or a momentum which would just sometimes come into the proceedings. But otherwise, I don't see any such reason. Maybe the commentary and the body language are still weak. People are guiding towards lower margins. Yes, I can't paint the entire picture for the entire sector. One can be selective, but ideally, as I said, there are more domestic-centric stories than something where you need to depend on exports. And I think a lot of innovation will go into the proceedings. The typical software exports, I think people need to innovate. They need to sort of get into digitalization, which a lot of companies are doing. But I am not seeing a lot of revenues coming out of those streams. So as I said, I'll not be very bullish on IT per se. Yes, at some price points, some valuations, it would become attractive, but not a conviction buy at all.
Got that. But what about mid-cap IT? So if the big concern with frontline IT for not buying is that there is no growth, but many mid-cap IT companies are giving you growth. But here the valuations are expensive. So what are you doing with mid-cap IT? And which IT stocks do you have in your portfolio? Or is it a zero exposure?
Yeah, so ideally, as I said, I have a zero exposure towards the IT stocks.
Zero.
But a stock like L&T Technology Services, just an example, LTTS, right, which is not a pure play IT. You would understand it's more digital, it's more AI, it's more ER&D. If I could make a point, I think these are companies where you will have lumpy quarters. But there is where the growth will come in, right? People want to improve their efficiency, their productivity. These are innovation-driven companies. So my sense that somebody wanting to buy pure play IT can probably wait for some time and have companies like LD Technology. I'm not suggesting, as I say, but it's a portfolio company that we hold for a lot of our clients. So that's an interesting play that one could probably look into.
Got it. Devang, you also mentioned that you would be looking at some proxy plays when it comes to consumption, when it comes to some of these broader market themes. Can you explain the reason to us, and which are some sectors that you are liking currently?
Very interesting. I think, see, what has happened is today, if you probably buy something in the benchmark indices, particularly Nifty or Sensex, we all know that 35% is the traditional financials that you get, 14-15% IT, 8 to 10% is the traditional oil and gas, and again, 8 to 10% is the typical non-discretionary consumption type of ideas. So 65-70% of Nifty is spread into this. So I think it's very important that one focuses on the broader market. In broader market, there are so many interesting themes, right? From discretionary consumption, of course, we know which is on the rise since COVID days. It's sort of slowed down a bit, but again, it seems on the up move. Most important part of this broader markets is where I use a word, and I've been repetitive over here, is something driven by capex. Now, by capex, I mean the entire capital expenditure that the government is doing. The private sector is probably also started to jump on the bandwagon. Now, the LIs and the proxy plays here are the last mile proxies. Be it power automation, be it liquid insulation, be it engineering, be it ER&D, which we talked about. There is lamination, stamping, casting. These are certain companies which are sort of never present in the Nifty at this point. But whether in the next 3 to 5 foreseeable years this will be part of indices, some of these companies will be part of indices. I think there are a lot of proxy plays here where you get one, ordering activity, second, the execution has picked up. Most of these companies have sort of reduced their debt, or these companies are debt free. Every incremental capital that is generated over here is put to work and generates more ROE. So my sense, a confluence of factors, be it lower inflation, be it supportive RBI, be it government policies, be it sentiment, liquidity, I think is making that domestic centric stories and the broader market stories more interesting towards capex, towards discretionary consumption, and some towards even financials, or I can say lesser known financials, which are proxy plays of financial penetration and density.
Since you're on the subject of proxies, what about the capital market plays? Devang, how would you play that theme? Would you play it directly from an exchange like BSE? Would you use the depositories like CDSL? Or would you use the asset managers or the likes of the HDFC, AMCs and the Nuamas? Where does your preference lie within this space?
Honestly, we find this entire space, the names you talked about, the sectors or the subsectors or the micro themes you talked about, all look interesting. But if you ask me today that what are the favorites over here, clearly we feel that the depository participants, exchanges, now clearly there is a duopoly, there is a sort of a oligopoly in this, and you know that there is a durable competitive advantage available to this type of companies where there are ROEs, there are ROCs, there is a bit of pricing power, there is a bit of moat which is available in this type of businesses, and we know that the penetration is going to rise, right? With 18-20 crore demat account, demat accounts are going to rise. You see a lot of capital market activity. You're seeing IPOs, you are seeing OFSs, you are seeing deals happening in the market. So I think the entire space, right from millionaires to billionaires, by the hour we see the market size increasing. There's a huge size of the opportunity with companies having dominant market shares, and consolidation is going to happen in this type of a space. So my sense, yes, a lot of these financial proxies, ex-banks look very interesting. Yes, banks will do good, but that would be around 10, 12, 14% type of growth over a period. But this financials, the financials that we talked about, the intermediaries, they could probably grow at 18, 20, 22% and more the merrier, that type of growth.
Got it, Devang. Thank you so much for joining us with your insights and telling us which sectors and stocks or themes could be in focus going forward as well. By the way, for the markets, it's a 140-point uptake. The mid-caps have also picked up pace. It's up around 0.7%. And it's really the pharma space or the chemical space, so to say, which is doing really well. So we have something like a Rosari Bio, which is up 6.5%. Aether Industries is up 5%. RCF, NFL, India Pesticides. So this theme continues to do really well in trade. So we'll have to see which way things go as far as the Q1 results are this time around for these names. But we'll slip into a break now. As we do that, here's some good news for our viewers. India's business news leader is now click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back. Tata Tech is higher in trade, up by nearly 1%. Now, Q1, no doubt, was a muted set of numbers. The company's revenues dropped by 4.6% quarter-on-quarter. Year-on-year, revenue contracted by 5.2%. Margins came in lower than street expectations at 13.6%. Then why is the stock higher in trade? Well, the key reason is the management is still very optimistic. They're talking about all the headwinds that hurt them to be temporary, short-term in nature. In fact, even though the analysts believe the company's top line will degrow by about 5%, and some of those estimates will come up for you on your screen, the management very clearly in our interviews said that we're confident that we will not degrow in FY26. They're confident that Q2 will be better than Q1 and of a strong H2. Also on margins, because margins, remember, declined quite sharply. They said that margins will improve. It will further improve once growth comes back. But the aspiration is margins will trend towards the 18% by Q4 of FY26. Full year margins will not be 18%, but they will trend towards the 18% mark. These are the EBIT margins. The company, I think, was looking at the EBITDA margins when they talk about 18%. But they also said that the North Star on margins remains 18%. So that's the reason why the stock is higher in trade, because the company is still very optimistic that things will improve. Even its peer Tata Elxsi, which reported muted numbers last week, is actually higher by close to about 3.5%. And many analysts had pointed out that, even it'll take a while for the auto ER&D companies to bounce back, spends will recover. It'll take a time, but valuations perhaps in the near term may have bottomed out, which is why even to a weak set of numbers, it's not that the stocks are reacting adversely. Now, the question is whether what the management says plays out, the recovery in Q2, a strong H2, or the macro uncertainty continues to, pull them lower.
Okay, take that point. So that explains the move on Tata Tech. But the other big story has been the June consumer inflation number, which has come in at a 6.5-year low of 2.1%, and it is lower than the CNBC-TV18 poll of 2.3% as well. Lata is joining us with her editor's take. Lata.
An ultra low inflation number. It's a 6.5-year low, the lowest since January 2019, just for the record. But importantly, it's been dragged down by food inflation. We can't even call it food inflation because it is deflation. It is minus 1.06. Prices have fallen by that much year on year. And the CNBC-TV18 poll actually expected flat, 0.1% rise. But this has come in deflation. And remember, the WPI also threw up a deflation in food. It's something we have to watch. To be sure, there is a high base, but this is an important level. The big fall is coming because of even month-on-month falls in cereals and pulses. Normally by June, this fall in prices stops because, there is monsoon dislocation of, supplies. As we look at veggies are up 7.5% month-on-month, June over May, which is normal. Because, again, supply dislocation, vegetables begin to rot. But if you look at the year-on-year, vegetable inflation is down by about 17%. So that's the extent to which food is not an issue. Core CPI has come in at 4.4%. Core is when you take out food and fuel, whatever is left, largely services. That's come in at 4.4. That also because it includes gold. That's also because there is a low base. All this base will evaporate. Even gold will plateau on year-on-year terms. So we are going to see core inflation also falling. The expectation is July is going to be below 2%. 1.8 is a kind of the dipstick survey for me. And there was one person with a reading of even 1.5%. So that's the kind of low for the full year. Most people are now looking at, below 3% below 4% for all of 2025 calendar. For the full year FY26, people are now looking at 3.3, 3.4. 12 month, that is 3.3, 3.4. RBI is standing at 3.7. So now the market is pretty sure there is space opening up for another cut. And more importantly, that liquidity will continue. See, if too much money is not pushing up goods prices, that's what you normally worry, too much money chasing goods and pushing up prices. If that's not happening, then, the Reserve Bank will be more relaxed with liquidity. So chances are we are going to, start seeing the bond market pricing in a rate cut. Yields didn't fall yesterday. They were open. The bond market was open when the numbers came. Yields didn't fall. That was because of US yields going up. But space for rate cut is clearly opening up.
Lata, thanks a lot for that. Hopes rising for another rate cut from the RBI. Now, Sensex India head Ravi Lamba has said that the private equity firm aims to invest around $10 billion in the country over the next 3 years. Now, speaking to Ritu Singh, Lamba added that the Indian market is a favourable environment for the company and accounts for 8% of its global portfolio. Listen into a slice of that conversation.
Financial services is a sector we've always been focused on. We've invested in the banks for a couple of decades now. We've invested in them. We truly see them as proxies for economic growth, and more importantly, as we see the sector expand, we are finding opportunities in insurance, which we have investments in both general and life insurance, in the listed space and in the unlisted space. We had a portfolio company, Niva Bupa, go public last year, so that's another good example of an insurance company that's matured to go to the public markets. And going forward, we see new categories of investment in the financial services space. I mean, we see opportunities in life insurance and general insurance, and beyond that, we see wealth management and asset management as well as emerging categories where we will look to deploy capital. Future consumption is changing rapidly, and short of the restaurants and the home delivery of food, the cloud kitchens are back. We invested in Rebel Foods last year. These are all playing to that same vertical, which is expanding very rapidly. So I see a lot of future here. The key question in all of these businesses, as you rightly point out, is to make sure you develop a business that's profitable and can stand on its own feet and does not constantly need equity capital to fund its growth. Because if that happens, then the burn rate can get to you. So you have to be careful about how you build these businesses. You have to calibrate the long term with the short term. And from our perspective, we are very happy and comfortable with our position in Zomato. It's done really well for us as an investment, but more importantly, from an execution perspective as well. So we see the long term. Quick commerce is something here to stay. Our exposure this year in March 25 in India on a mark-to-market basis is at $50 billion US, and it was $37 billion last year. So it's grown quite well. And what happened 2 years ago when we said, looking forward, we can see the potential to deploy $9 to $10 billion over the next 3 years. And, we've been well on track on that. We deployed just under $3 billion in the first year, and, we've deployed more than $3 billion last year. And this is not a number that we are so fixated on. It's a number which we are hoping to deploy. Going forward, we can deploy more than, the $9 to $10 billion that we talked about. Depends on the opportunities we find.
Well, that's the big interview for the day. For the market, still holding up with a gain of about 0.5%. The Nifty's gained more than about 100 points after getting precariously close to the 25,000 mark yesterday. 25,002 was the intraday low. Markets have recovered nearly about 200 points. Auto is leading from the front. So we spoke about MotoCorp, the annual report takeaways. That's your top gainer, 4% up. It's even surpassed the 200-day moving average, so technically important. But look at Bajaj Auto, Eicher Motors, M&M. Across the board, these stocks are higher. It also helps that, IT is not dragging today. So there is one HCL Tech, which is under pressure, but the rest of the IT pack is higher in trade. In fact, the Nifty IT index itself is also up in the green. Realty is another big mover. PSU banks up and about. Capital markets strong for the second day in a row. And Pharma too is contributing on the way up. Well, that brings us to a close on this edition of Trading Hour. From the entire team, thank you for watching. Don't go anywhere. Halftime report is up next.